Good evening, everybody. Distinguished guests, participants, ladies and gentlemen. I'm delighted to address this august gathering of distinguished persons and key stakeholders across the financial spectrum on the theme of Banking That Builds Bharat, AI-powered, credit-driven, which is extremely contextual and relevant and encapsulates the spirit of Viksit Bharat. The Indian banking system has time and again exhibited its capability to embrace and adapt to newer technologies. Beginning from the early days of computerization in the 1980s, to the spread of ATMs in the 1990s, the expansion of internet and mobile banking in the 2000s, the interoperable infrastructure for payments, data repositories and data sharing since 2010, the banking sector has adapted successfully to the requirements of the changing times and has over the period made banking more efficient and inclusive. Banking has now entered into a new phase of evolution driven by digital democratization. A prime example is the homegrown unified payment interface, which has made India a global leader in digital payments, which reinforces our belief that responsible innovation can be a powerful driver of progress. The Government of India has articulated an ambitious vision of Viksit Bharat that is transforming India into a developed country by 2047. This sets the tone for the next step in our technological journey for the financial sector and more specifically in the banking sector. Under Viksit Bharat, the goal is for every adult to not only have a bank account, a target largely achieved under the Jan Dhan Yojana, but also have access to affordable credit, insurance, and investment options. The endeavor of banking sector should be to ensure that the benefits of banking, more so of credit accessibility, is made available to the customers across all segments on a fair, transparent, and affordable basis. Over the years, the banking credit has been robust, averaging around 10.5% over the last 5 years. The share of retail credit has gone to about 32%, while the share of credit to MSME sector has been growing steadily, forming almost 18% of the total bank credit as of March 2025. Before delving into the role of new technologies, let me briefly touch upon the steps taken by the RBI over the years to increase the flow of credit. RBI has undertaken several measures to expand both the reach and depth of credit by reducing friction, increasing access points, and lowering the cost of financial service delivery. Key initiatives include the Aadhaar-based KYC, the Central KYC Registry, the revised priority sector lending norms, partial credit enhancement guidelines, and the account aggregator framework. In response to the growing digitalization of credit, the digital lending guidelines were introduced to ensure transparency, fairness, and protecting data privacy while enabling direct fund flows through digital lending. The RBI has also enabled formal credit access through frameworks like the TREDS for the MSMEs, co-lending models between banks and NBFCs, as well as launched targeted refinancing schemes. More recently, the Reserve Bank has, in collaboration with its subsidiary, the RBI Innovation Hub, tested a prototype of a public platform for frictionless credit to enable seamless digital data flow to lenders. Building on this, the unified lending interface is being developed to transform credit delivery by integrating access to both financial and non-financial data, such as digitized land records, the GSTN data, property records, and satellite data, along with services like eKYC, the account aggregator framework, and the credit guarantee schemes. This ecosystem aims to make lending faster, cheaper, and more accessible to the underserved segments. Together, this digital public infrastructure and an enabling regulatory framework would help to drive inclusive credit growth. Having said that, a lot of distance still needs to be traversed as the gap in credit penetration persists. Even today, only about 25% of India's adult population have formal access to institutional credit, while in the MSME sector, which contributes almost 30% to the GDP, only about 40% of the credit needs are met by the formal institutions. While the Financial Inclusion Index developed by the Reserve Bank has shown steady improvement, rising from 53.9 in March 2021 to 67 in March 2025, which reflects the growth in account ownership and credit access, scope remains in affecting improvement in the usage and quality of the services delivered. The gap between inclusion and credit access is a challenge and an opportunity to the banking fraternity. The credit needs to not only grow in terms of volumes and numbers, but also needs to be directed towards productive sectors that deliver higher multipliers, such as the MSMEs, infrastructure, informal sectors, and the rural population, to achieve not just the goal of a Viksit Bharat, but a Samaveshi Viksit Bharat. Driving the next credit revolution would require harnessing new technologies. Over time, the role of technology in finance has shifted from improving operational efficiency to fully automating and centralizing previously manual fragmented processes. Among the emerging technologies, artificial intelligence stands out for its vast potential for strengthening the internal operations and risk management to deliver faster and more seamless customer experiences. Reports indicate that nearly 68% of the banking and financial service industry organizations in India adopt some form of artificial intelligence in 2024. An RBI study of the bank's annual reports also shows a sharp rise in the reference to artificial intelligence, underscoring its strategic importance. While both demand-side factors, that is the profitability, competition, and compliance efficiency, and supply-side drivers, that is technology advances, data growth, newer business models, influence artificial intelligence being adopted, supply-side forces remain the primary catalyst. Artificial intelligence as a discipline has evolved over the decades and has seen rise of machine learning systems which can learn from historical data to make decisions, often with high accuracy. Indian banks and non-banks embarked on the artificial intelligence journey nearly a decade ago, mainly handling at that time large volumes of information and supplementary analysis which added value without displacing established systems. The adoption has since moved from deployment of artificial intelligence for back office functions, for efficiency enhancements to more varied use cases such as areas of fraud risk management, optimizing IT operations, facial recognition for KYC, credit scoring, claim processing, and customer-focused services. As observed in the surveys conducted by the Reserve Bank in 23 and 24, more than three-fourths of the banks have deployed artificial intelligence-powered chatbots for customer service. This marks a fundamental shift where AI is no longer just an enabler but a participant in the decision-making, product design, and customer engagement. Though the banks have been using artificial intelligence in some areas of lending, this is a potential use case. There is a potential use case for its usage across other areas of the credit life cycle. Let me highlight a few. One is credit inclusion. An important use case would be in the way credit is assessed and distributed. This would require supplementing existing assessment methods with broader data-based and more refined analysis, whereby financial institutions could gain additional perspectives on risk and capability of the potential borrowers. This would be a significant game changer to address credit requirements of the millions of credit invisibles, that is, the people with no formal credit history. However, given the availability of other digital footprints, artificial intelligence can be adopted to leverage alternate data sets to assess creditworthiness, especially that of the new to credit customers. This would mean a paradigm shift from asset-based lending to cash flow and alternate data-based lending, promoting a journey from exclusive banking to an inclusive digital finance. Government of India has also recognized the artificial intelligence potential to drive financial inclusion and has started initiatives such as the Grameen Credit Score, which aims to provide underserved communities with formal credit access by analyzing alternate financial data including UPI transactions, government subsidy receipts, and utility payments. Artificial intelligence also influences the turnaround times. It enables banks to process large volumes of customer data quickly, accelerating credit decisions and service delivery. This is especially valuable in time-sensitive sectors like sanctioning of working capital for the MSMEs, where the AI can analyze diverse data sets like bank statements, payment histories, GST filings, e-invoices, trades receivables and patterns, and public records. It also aids lenders in assessing seasonality, supply chains, inventory cycles, customer concentration, thereby help to assess the overall credit worthiness of the MSMEs. Of course, in credit appraisal, the banks can embrace AI algorithms for leveraging behavioral analytics by analyzing a vast amount of transactional data for detecting patterns indicative of creditworthiness and stable financial behavior, which can lead to more accurate credit assessments and improve the decision-making processes. Artificial intelligence ability to dynamically assess customer preferences and behavior can empower banks to offer customized credit solutions tailored to an individual's financial capacity rather than relying on outdated credit assessment. This not only improves the loan accessibility but also ensures that the borrower receives fair and structured financial products that align with their needs. AI-based early warning systems can help to lenders to monitor credit portfolios more effectively through dynamic risk scoring and real-time default probability tracking. By flagging early signs of financial stress, these systems protect the lender's balance sheet while giving the borrowers a chance to correct the course. The goal ultimately is not just to lend more, but to lend better. Artificial intelligence would also play a key role in automating document verification by assessing image quality, ensuring compliance, and reducing lead rejections. It can accurately process large volumes of records, classifying, extracting, and validating key data, thereby improving efficiency and minimizing errors in the lending processes. One promising use case of artificial intelligence is the development of multilingual chatbots and voice assistants which enable customers to interact with banks in their native language. This is a revolutionary change as by localizing the user experience, the AI can enable more people across different languages, literacy levels, and abilities to confidently use formal banking services. I'm told banks are also experimenting with using artificial intelligence to enable staff to respond to customer queries, which can enhance the customer experiences going forward. Timely resolution of customer queries boosts trust in the banking system and encourages deeper engagement, furthering financial inclusion. As digital access has expanded, so too has the customer complaints. This highlights another use case for the artificial intelligence. It can efficiently categorize, prioritize, and route complaints, enabling faster proactive resolution by detecting patterns and addressing root causes before the issues escalate into grievances. Artificial intelligence-powered loan servicing platforms can create personalized repayment solutions and reduce operational errors across servicing and for portfolio management. They can also provide new ways of loan servicing by supporting collections and recovery through prioritized outreach strategies. AI can help to strengthen compliance with auditable trails of measures initiated for recovery. AI also holds potential for safeguarding the financial system itself. As cybercriminals increasingly use AI for sophisticated attacks, the regulated entities can leverage artificial intelligence-driven tools to protect customers and detect threats. AI can monitor large transaction volumes in real time, flagging anomalies that may indicate fraud or money laundering. especially in complex areas like crypto transactions, where parallel financial channels exist. With the fintechs advancing rapidly, the regulated entities are increasingly partnering with them across the credit life cycle. A key model, digital lending under banking as a service, involves embedding processes like KYC, credit assessment, and recovery directly into the fintech platforms. While such collaborations enhance financial inclusion and innovation, they can also bring risks such as blurred accountability, data misuse, inadequate grievance redressal, and potential mis-selling. The guiding principle to address this remains the premise that regardless of the model being used, accountability ultimately rests with the regulated entity. Technological advancements come with the challenges that the regulated entities must recognize, as these risks can undermine the benefits of innovation. For example, the recent Supreme Court ruling on the video-based eKYC highlighted that mandatory automated processes may create barriers for people with disabilities, underscoring the need for fairness and accessibility in technology adoption so as to avoid exclusion. Artificial intelligence without proper controls can introduce risks like algorithmic bias, lack of transparency, ethical concerns, and systemic vulnerabilities. It can also amplify the existing risks such as third-party dependencies, concentration, model, cyber, and data privacy risks. Let me highlight a few of this. Even as artificial intelligence adoption grows, financial institutions increasingly rely on complex networks of external service providers, cloud platforms, artificial intelligence vendors, and data aggregators. These interdependencies create hidden vulnerabilities where a disruption or a breach in one link can cascade across multiple institutions, disrupting critical services. The complexity and opacity of these layers makes it difficult to identify risks, allowing them to accumulate unnoticed and spread rapidly during shocks. A critical vulnerability of artificial intelligence is its potential to synchronize behaviors across financial system. When institutions use similar models trained on overlapping data, their decisions on asset pricing, credit assessment, trading may align, creating hidden linkages. This can amplify market stress, spreading shocks rapidly, worsening liquidity shortages, increasing asset price volatility, and trigger sharp, self-reinforcing market swings. The integration of artificial intelligence into the financial system, especially through new interaction methods and increased reliance on specialized providers, expands the cyber threat landscape in unpredictable ways. AI strengths such as reliance on large data sets, open interfaces, and automated decisions also create vulnerabilities. Malicious actors can exploit these through adversarial attacks or compromised training data, potentially corrupting artificial intelligence outputs. Even a single breach can disrupt critical operations and undermine trust in the artificial intelligence across the sector. Then, of course, the one important point is the model risk. Unlike traditional models built on clear rules and well laid out assumptions, artificial intelligence models operate through dense, opaque algorithms, which we refer to as black boxes, and may evolve with the data which they consume. This introduces the risk of prejudice within the models, where biased data, opaque design, or untested assumptions may lead to biased outcomes of the model. Such distortions can lead to unfair credit assessment, exclude deserving segments, or conversely extending credit where risks are understated. AI is only as strong as the data that shapes it, and this leads to the host of vulnerabilities emanating from data quality. Currently, while much of the financial data is structured, much more of the data is fragmented across systems, often in inconsistent formats, somewhat incomplete or outdated, or skewed by historical biases. When such data flows into AI models, It can produce results that may appear authentic, but suboptimal, and in some cases may produce wrong outputs. Over-reliance on such models can quietly turn data gaps into large-scale misjudgment and wrong business decisions. Generative AI models are often trained on publicly available data like news articles, stories, and explainer videos, and this may lead to intellectual property and copyright infringements. The Reserve Bank's Financial Stability Report has pointed out that high market concentration in critical third-party service providers of cloud and AI services, noting that heavy reliance on a small number of tech players could create single points of failure. Such concentration risks are compounded by vertical integration of certain providers who supply not just models, but also the underlying infrastructure and the data sets. While AI is transforming many of the processes of the financial institutions, the rise of generative AI has also lowered the barriers for fraud, putting powerful deception tools in the hands of malicious actors. Deepfakes can mimic voices, faces, and documents with unsettling accuracy, while AI-generated phishing lures, faking identities, and forged credentials can slip past traditional checks. In the light of these multifaceted risks, some of which I have touched upon earlier also, it becomes crucial that adoption of AI in banking sector must be done in a responsible and measured manner. The excitement around the AI's benefits should not overshadow prudent risk management. In this context, the following aspects become crucial. First, of course, is governance. A robust governance is indispensable for ensuring the integrity of data, the reliability of the models, and mitigation of the risks associated with the adoption of AI. The financial institutions should have in place a comprehensive strategy for AI adoption. It should be accompanied by clear policies, risk appetites, and ethical standards that cascade throughout the organization. Robust monitoring and reporting mechanisms should be put in place to ensure alignment between the innovation goals and institutional stability. Further, in a regulated industry like banking, it's essential to understand how a model arrives at its decisions, making explainability a critical requirement. Thus, there is a need for financial institutions to invest in explainable AI frameworks that provide clear, auditable reasons for loan decisions and services. Strong governance is central to the managing of the AI-driven model risk. While AI can automate and recommend, humans should be responsible for the decisions. Financial institutions, while adopting artificial intelligence for business processes, should implement the principle of keeping a human in the loop to ensure that AI is leveraged as a tool to support and enhance human decisions and not replace them. High quality data is the backbone for safe and effective AI in finance. While the RBI already collects data through supervisory reports, regulatory returns, and surveys, the introduction of model risk guidelines aligned with global best practices could extend the scope to include data on AI models used by regulated entities. Financial institutions should therefore adopt robust data strategies incorporating diverse, reliable indicators that reflect both the scale of AI adoption and the associated vulnerabilities. When AI is used for credit decisioning or financial inclusion, especially through alternate data sets or use of alternate data sets, customer data becomes central, making privacy and security paramount. The Data Protection Act of 2023 provides the legal framework for responsible data use, and the financial institutions must ensure compliance through a consent-based, privacy-first data handling practices. The continued investment in research and development is critical for advancing the capabilities of AI in the lending lifecycle for unlocking new opportunities. Research efforts of the financial institutions should focus on improving data quality and accessibility, developing novel artificial intelligence algorithms for enhancing credit inclusion, and addressing key challenges relating to bias, fairness, and interpretability of the credit evaluation. Collaboration and knowledge sharing among the industry stakeholders, including financial institutions, fintech companies, and academic institutions, is essential for driving innovation and addressing the common challenges in the AI-driven credit processes. This can foster the development of best practices, standards, and frameworks for responsible AI use, promoting transparency, fairness, and accountability in credit evaluation. As AI adoption gains traction, regulatory oversight is crucial in ensuring an efficient, responsible, and fair adoption. Recognizing the increasing usage of model-driven credit assessments and decision-making in the regulated entities, the Reserve Bank has issued a draft circular on model risk management in credit, setting out the expectations on governance, validation, monitoring, and accountability. Building on this foundation and recognizing the increasing usage of models by regulated entities, not only for credit functions, but also wide spectrum of processes, we could look at as expanding the scope of these guidelines. As technologies like artificial intelligence are generally not adopted uniformly across the sector, and owing to presence of varied types of entities with different scales, the principle of proportionality also has to be factored in. The objective would be to ensure that all regulated entities can adopt technologies best suited to their business models and customer needs, while effectively managing risks as explainability, algorithmic bias, resilience, and over-automation. In continuing of this approach, the recently released report of the Committee for Framework for Responsible, Ethical, and Efficient and Ethical Artificial Intelligence has laid down the 7 sutras for trustworthy AIs and has emphasized the need for a robust model risk management framework within the regulated entities. Over the decades, Indian banking sector has exhibited its ability to adopt meaningful technology. Even as AI transforms financial services, it's clear that there is a development which is not a mere upgrade but a major shift impacting product, processes, and operations. The long-term implications of AI adoption on the financial system remains uncertain, but exhibits potentially far-reaching consequences. Therefore, an imperative for the financial sector to approach AI adoption with foresight, investing not just in innovation but also in resilience, building strong governance structures, diversifying from dependencies, and engage in continuously assessing the emerging risks and ensuring that their AI strategies align with long-term safety and sustainability of the financial system. Ensuring AI-driven decisions are ethical, unbiased, and transparent will be paramount in building a sustainable AI-powered financial future. This calls for optimistic vigilance, wherein AI and other technologies in banking are neither feared nor embraced blindly, but navigated through. The Reserve Bank, on its part, will continue to provide an enabling regulatory environment that together we can build a banking system that truly builds Bharat, and not just builds, but transforms Bharat. Let me sign off with a thought. Trust is the currency of banking. Even as we broaden the credit coverage using algorithms and digital interfaces, maintaining this trust will be the biggest challenge and also our biggest responsibility. Thank you.